Hey Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, we're going to go over that drop on the Bitcoin chart as we did see Bitcoin just returning to the bottom of its wedge. Guys, Bitcoin decided not to join the stock market in the rally. Of course, the Fed did pause interest rates, but we're still in this pattern here. I think that the pattern is just going to have to play out, guys. I mean, that's the whole logic behind pattern trading to begin with, is that they tend to work out. Now, if we do just take a look at that wedge, you can see that we are in the area where I was suggesting that if we retest the lows, then there could be that potential breakdown, which does correspond to the typical pattern of a falling wedge, where you usually get 1, 2, 3, 4, 5 drives within the wedge itself, and then a breakout to a measured move, which in this case would be $30,000, but that typically we see a fake out before the breakout. And this happens quite often in these formations where the breakdown is used to grab liquidity. Okay, you see this free liquidity over here where a lot of people just had stop losses as this chart was skyrocketing. And basically, the market makers push down, they liquidate those people, and then they use that money as rocket fuel to buy their way back up the chart. That's the whole premise of these liquidation events. It's just about money, just grabbing these people's money. Whoever entered down there and put their stop loss a little bit too high, right? Just grabbing their money and then using that to buy their way higher in the chart. And then once we get to the measured move, then we have to see what happens from there. Do we end up making a higher high? Do we end up just consolidating? Or do we get some type of a hard rejection from there? Okay, and that would be a very typical thing to happen for us to just play for that liquidity. So, guys, if we do continue to break down, please don't be surprised. I think over the last multiple episodes, I have been warning you of the potential for a breakdown here, and that I have been eyeballing 23,000 to 21,000 as a potential reversal area, if not just at the top of this kind of area over here at 25 to let's say $24,000. Guys, if we do just throw on some support and resistance, okay, we can zoom in here and we can see currently we're at an area of support that corresponds to this kind of area right here, this area right here, this area right here, this wick over here. This is all, and then there's also a little bit of a support over here. So this whole kind of like little zone, if you can see on your screen, it's like this gray zone. It does correspond to what we're pushing through here. And if I zoom in, pardon me, you can see that we wicked almost precisely to the bottom of that zone that I've had marked out for months now, guys, okay? And so it just corresponds to this area. We're going to have to see, do we break below that, which is at around 24,800, let's just say. Do we break down below that? In which case, we might be looking towards that 23,800, $24,000 down to, low $23,000 as the next kind of like major stop. Of course, there could be a little bit of an intermediate zone here. You see a little bounce here, a little bounce here, somewhere around 24.3. But guys, overall, this thing is pushing down. And so if this wedge does want to put in its kind of liquidity grab to grab this free liquidity over here in this fair value gap, then that could be very possible. And one thing that I want to bring up, which of course we were talking about for a couple months actually at the top of the chart, which was that this was a very toppy formation, and that of course it had a kind of I call them pseudo head and shoulders. And the reason I call them pseudo head and shoulders is because this shoulder is higher than this shoulder over here. And so It's not perfect. It shows that price action is actually still rising. Whereas if you had a higher shoulder over here and then lower price action over here, that would show that price action was dropping. Well, these kind of like pseudo head and shoulders, they tend to get a little bit of a delay. We saw that delay. We broke below the neckline, but we didn't just dump to the measured move on the head and shoulders. We actually ended up just drawing this out until we did make a lower high. So essentially this area right here is lower than this shoulder over here. And that gave us kind of our downward bias. We were hoping that we would hold the neckline, which is basically the middle of that wedge. Okay, so you can see the middle of the wedge right there. That was the line in the sand that I gave you. I kept repeating multiple episodes. 27,000, 27,000, 27,000. We broke down from 27,000. We retested it. We kept testing the middle of the wedge. And now we're showing weakness because we're not coming back up to the top of the wedge. We're not flipping 27,000. We're coming back to the bottom of the wedge. And this was the day that we had to make the decision. Okay, we had to make the decision today on this good news from the Fed, on the good news of the PPI data and the CPI data. Um, you know, was there strength here or not? And it's showing that there's not strength. So this isn't going to be a clean wedge. It's going to be potentially one of those dirty wedges. And I just want to point out that the measured move here on the head and shoulders, is pretty much what we would expect for a wedge breakdown. So these patterns are somewhat reinforcing themselves, and that does suggest a little bit of confluence for pattern traders, where if we had a breakdown and we were going to grab this liquidity over here, then we would expect that this head and shoulders measured move breaks down to the red line somewhere around 23,000. The liquidity is grabbed, and then the measured move for the falling wedge might end up playing out to 30,000. That's just going to wreck the bears. This is going to wreck the bulls. This is going to wreck the bears. So everyone gets wrecked. Okay, guys? And this was, of course, just a wick to liquidity. And this is also a measured move here, but it's also a wick to liquidity if you think about it, because let's say that you were shorting from the top here, right? You might put your stop loss up here, put some stop losses. People who keep joining the shorts, right, as we start to short down this thing, they just have their stop losses along this area. And so by having that measured move to the upside, they get to liquidate all those people's stop losses. So if you've never thought about what's actually happening on the charts, now maybe you can understand that the reason why we could very easily drop down here is to basically fill in that fair value gap, as well as to take out some stop losses that people may have put in place on our way up. Okay, and there just wasn't a lot of time to trade on this candle, and so this also gives a second chance for people to trade on that candle because it just pushed up way too fast. And then if we end up pushing back up, that's going to take out these stop losses. And of course, the market makers get to take all of this money, and they get to also take all of this money. And any poor, unfortunate traders who were caught in the crossfire of that, unfortunately for them, they get hurt. And that's the same premise of what happened if we take a look back here, right? This one right here, essentially it filled in part of this fair value gap. It also got rid of all the stop losses over here. And then we shot up and we took out all the stop losses, that had been built up along this way, right? And so, guys, essentially the market makers took this money and they also took this money before using that as rocket fuel to push up. And this is my premise, okay? This is what I think is going to happen. So we have the wedge, we have a typical kind of, formation there, typical kind of liquidity grab, a typical liquidity pump, and then that's the true test. This is when the chart really gets tested. Do we just double top? Do we make a lower high? Or do we flip this and make a higher high and continue on our way like we did over here? Okay, so again, I'm not bearish yet. Okay, I know we've been pulling back a lot in the charts, but I'm talking about on a macro basis. I'm not bearish. I'm not bearish on the macro until we lose probably 17K. Under 17K, then we're going to be underneath the monthly volatility pivot, and we're going to actually be under all the volatility pivots on every time frame. So if we drop below like 17.5, 17K, then I'm going to be saying, okay, it's lights out, it's game over, right? Gonna have to figure out what's going on. A new bear market is going to be initiated underneath 17K. But anywhere, right, between where we are and essentially like 18K-ish, right, 17 to 18K-ish, this is fair, fair play for some type of shenanigans. Okay, just you got all this. You have these value gaps over here. You have these fair value gaps over here that this one didn't take out. So there's a lot on the table here, right? Just for shenanigans, just for market makers to take out as rocket fuel to push, God knows how high. I would suspect not higher than, 55,000. And I would think that a good target is maybe that kind of 42,000. And I still think that, those type of numbers at like 32 to 35,000 are pretty reasonable as we explore, this range, basically this range that we're in here, including the wicks, okay, which, they can push into each other's territory, okay? These wicks are moving up, these wicks are moving down. There's just kind of this ambiguous zone here, and it kind of maxes out around that 33,000. And if you have just a fake out, you could push up even a little bit higher, to maybe 35 or something. And that could be just a deviation and a fake out, and then it comes all slamming back down. But again, we're just doing a really normal kind of healthy kind of candy cane kind of shape as we're stepping up, right? As we're stepping up in price. And if we do it again, people are going to be freaking out right here, just like they're freaking out right here, just like they were freaking out right here. But again, this is just very healthy price movement. Now, the lower we drop, the more we get to be at risk of like, just stair stepping the wrong direction. And, they often say you take the escalator down, right? And so it could get ugly pretty fast. But I just can't say anything too bad about what's going on in the chart. This is just like a longer version of this. That's all. And if we look in the past, we get these things all the time. Candy cane, candy cane, candy cane, candy cane, kind of candy cane, candy cane, right? On the way up, candy cane, candy cane. So, if we do it again, like, what's the big deal? Okay, like, again, like people are just freaking out for no reason. But I can understand why this chart is being delayed. Guys, I do have a theory, a concept of the market here, which is that essentially AI, okay, AI is replacing Bitcoin and crypto right now in this cycle. It's a very rare opportunity. The stock market doesn't usually have this kind of an opportunity. They're essentially trading AI companies kind of like their cryptos, kind of like their shitcoins, guys. Okay, they're looking for like a 4x, that kind of thing off of the moves on AI. They're just really trying to, just go for maximum profit here. And in the face of that, while there's this kind of AI narrative going on, it's very hard for something that's just doing like, 1x, 2x at most, to move its way up. Because why would you put your money in this? Right? Why would you put your money in BTC if you can put your money into AI in a company that actually has profit, right? And so while the AI hysteria is going on, right, while AI is essentially going like this, then you're seeing Bitcoin go like this. Okay, so this is AI and this is Bitcoin. Now, what happens when AI finally hits a kind of ceiling and it has to go into a consolidation of its own, kind of like what Bitcoin's doing? Then money, I believe, is going to flow back into Bitcoin and we're going to see that pump that we wanted to. Okay. I didn't think it would take this long, but 2 to 3 months is pretty typical. And again, we can go back. You can see this one was quite accelerated. This was accelerated. This one took, a couple months, right? And in the past, they've not been the quickest things, okay? Now, this is one of the longer formations that we've had, but again, just nothing special is happening. I just think that risk on money is going into AI right now. And that's why we're seeing just a Bitcoin and crypto struggle. And it's just a great opportunity for the market makers to essentially liquidate people and just kind of gather some rocket fuel for the next stage up so that when AI comes down, Bitcoin can kind of shoot up again. And, we'll test that theory. We'll see what happens when NVIDIA comes crashing down to retest its lows, or it comes back, or it enters a very long consolidation phase. Then, we could see this chart just do exactly what I've been saying and pump, and then we'll hit some type of limit, double top here. It could be 40, it could be 50, and then probably it will have a crash down. Maybe it tests that bottom that I was talking about, like at 17, 18, or maybe 20, or it could be just 25 again. We don't know yet. We have to measure it at that time. And then, we just grind it out for the next half year or so. And eventually the halving happens on Bitcoin. And then, the bull run eventually returns when the Fed starts to inject money back into the market. We're just doing a pause right now. We're still having issues, right, with the economy in terms of interest rates and inflation and bonds and all of these things. And so there's just not that much liquidity really to go around. And so we're not going to see those major pumps until we get loosening conditions. We're still in tightening because we're still technically fighting inflation, um, even though we're now on a pause, which does suggest that some liquidity could be freed up in the future. And the good news is we didn't do more tightening on this Fed round. So when money flows out of AI, it has the opportunity to flow into the other stock indices. It has the opportunity to flow into crypto. It's just why you're going to have your money anywhere else but AI right now. Okay. I hope that makes sense, guys. Sorry, just having a sip of coffee there. And that's my theory of the market. And I just see this as really normal. Okay, just really normal. We see it all the time. Okay, we see this stuff all the time, both on the way down and as I already showed you on the way up. We see that stuff all the time. Okay, it doesn't mean it's good or bad. It just means it's healthy. That's all. And how far we go down, again, it just depends on how much time liquidity spends in AI or other parts of the market, and also how heavily the market makers want to drive down to fill in some fair value gaps or liquidate some stop losses. Okay, they could come all the way down. We could double bottom, okay, and that'd still be very healthy as long as we maintained some semblance of a higher low, right? It'd still be an uptrend overall. And certainly, as long as we're above 20,000, we're definitely in an uptrend. Okay. I mean, how is that not an uptrend, right? So this is what I'm thinking about in terms of philosophy, guys. I think that we can just jump down to the. Let's actually jump down to the 15-minute. The day hasn't closed yet, so I don't have really new numbers to give you, but we can take a look at the numbers that I gave you last night because I do want to do some transparency. And I'm also trying to add this kind of learning segment, right? So here were the levels that we marked out on the 1 hour. Again, I'll just use the 1 hour. We can actually analyze any of my momentum pools and volatility pivot kind of systems, but we get a really large data set when we look at the 1 hour while on the 15-minute chart. So that we're on the 15-minute chart and we're looking at the 1 hour analysis that I gave you. So let's go ahead and just throw on the learning. I'm just going to add to it. See, we already analyzed it in the last episode, but now we're going to analyze the next one, okay? So, and look what happened, guys, okay? I can zoom in here. And this is where it was when I put the momentum pool in place. Now, let's see, that may be a little bit difficult to see. Maybe I should increase its color just a bit. And you can see that momentum pool. That's where I had the momentum pool start. Now we were breaking down into it. And so, yeah, you absolutely could have taken that trade. As soon as we broke down into it, look, we never actually went out of it. We just crossed it. And so that was a clean trade to take. In fact, I think this one was happening live when I was recording yesterday. It was happening live. And look at this clean trade that we got. Okay, you just took the risk, guys. You took a chance. Okay, when we entered my momentum pool coming down from it, you took the chance and you took the short, and then you got this nice trade here. Now, we did reverse at some point around the volatility pivot. We tested it, and then we ended up, the next candle ended up recovering it. And so you could have longed off of the volatility pivot. There's nothing wrong with that. You could have taken that whole long. The premise of this system works that way, and we would be above the volatility pivot. So you definitely could take that trade if you wanted to, in which case, look, we never broke down below it. It was an absolutely clean trade at the point of entry. Just put a stop loss right below it at the point of entry. Just take it all the way, just take it all the way until it basically finishes itself off. Essentially, if we break into the momentum pool and we break out of it, if we come back into it, that's your shorting signal, right? So we got another shorting signal. And, look, we got a nice, kind of snipe trade off of it. It never liquidated you. Okay, it never liquidated. It never came out of that pool during that time. Okay, it ended up reversing. We ended up coming back into the pool. And when this was a bearish candle, but when we got a bullish candle, we entered on the re-entry on a bullish candle. And so on the 15-minute, you entered there. And in this case, there was a little bit of a wick. So you can see that you want to give yourself a little bit of a buffer around the momentum pool. But more specifically, I think I can tighten this one because it looks like TradingView moved it. There we go. There we go. Yep. Yeah, I think there we go. We can see it's the green lines that define the pool. See this add lose momentum, the hold momentum, whatever's in between there. And again, this one just got expanded a little bit higher. Pull it down a bit. And for some reason, TradingView moves these boxes a little bit. That's why I also have the lines, guys. Otherwise, I could just have the box, right? But anyway, guys, you can see that as soon as we got into the momentum pool, you could take that trade. It never came back out until it crossed here, and then it came back down, and then you could have taken the trade again. Okay, so I'm just kind of making a shortcut here. In fact, this was the trade, and then we had another drop, right, where we re-entered the pool if you were trading on the 15-minute. And then we actually re-entered it. And so look how many trades that you got, and they're all clean. You don't get liquidated on any of them. And then we had another one. Okay, we had another short. And then we had another long. And again, it's clean. As soon as you entered, you didn't get liquidated. And then this one was the long one. Okay, so I just made a shortcut because there's just so many stacked up here. But look, you could have just been trading just consistently all throughout the night. Okay, just based on my 1 hour chart, you could have just been longing right off of the momentum pool, just up and down, up and down, up and down. You wouldn't have been stopped out once. There's one little area that's a little bit ambiguous. Maybe you would have broken even, right? And but the rest of them super clean. You ended up dropping down. When you re-entered the pool, you could have shorted that. Okay, we got a little wick to here. When we re-entered the pool, you could have longed it here. And then we broke down. This one wasn't very clean, but that was on a wick basis. It wasn't on a closing basis. If you have a closing candle inside of it, you can short off of that one. And then we pumped back up. And then from that pump, you got this trade. Again, you came down. This one actually did cross. So there's actually, let's see, 1, 2, 3, 4, 5. There's actually 5 trades stacked up against each other right here, and they all cross the momentum pool. Now, this momentum pool is really, really slender, okay, guys? But you can imagine if it was a fatter pool and these were bigger swings because there was more volatility in the market, that you could have been highly successful. However, that's not the key point because you could have just continuously traded it, and anywhere you took the trade, you would have been successful. Okay, it's almost a guaranteed thing. It's almost a sure bet. Okay, much, 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 much higher. My strategy here is much, much higher than 50-50, guys. Okay, and that's what most of trading is, just 50-50. I think it's going up. I think it's going down. Well, I've got a strategy that has almost 100% hit rate. Okay, so just think about that. Anyway, there's like 5 trades in here. You'd have to be on the 5-minute to really see it. In fact, we could jump down to the 5-minute, and then you can see just how many times it just crosses back and forth, okay? Well, I think just fast forward because we don't need to get all the gory details. You can see it just posted out here. Anytime you enter the pool, you short. Anytime from the top, anytime you enter it from the bottom, you long. Just take a chance, okay? And then you can see some pretty amazing results sometime. And the thing is that even though we had low volatility, just like I was telling you in the last episode, even though we had low volatility, if you take your chance on those plays, okay, and you really tightly control your risk management so that you're winning more often than you're losing, and when you lose, you don't lose more than what you win, right? You don't, because some people, they just take big hits on us on their losses when their stop loss gets triggered. So you have to manage that very closely. But assuming that you're able to do that, at some point the volatility will increase. And when you get a random volatility expansion, right, and you're already, for example, shorting here, and that short has just led you to violate the volatility pivot, then, you know, having broken that and then also just randomly, like the market got crazy, right? The market just randomly got crazy. We didn't know, is it going to go up or down? Most likely it was going to go up because the CPI data and the PPI data and the Fed news, they were all good news. So there was a higher statistical likelihood that markets were going to pump off of that, or at least that they'd be neutral. But the momentum pool, okay, and that's just our feeling, guys. That's just our feelings on it. That's just what historically, we feel happens in the market when there's good news in the market. But what the momentum pool was saying to us was saying, look, you pushed up, so there was like another green trade right there. You pushed up, and then when you broke back down, right, you entered the pool, take that short. And look what happened. Look what happened. Within 5 candles, we already had this we captured the whole move to the downside. Nobody knew if it was going to be good news or bad news. Nobody knew what was going to happen, but the momentum pool pushed you in the right direction. Okay. And again, like there's at least like one, and four, there's at least like 5 more trades on here that I didn't outline, which if we could see it on the 5 minute, but I'm on the 15 minute right now. That's using the 1 hour chart. Okay. So again, guys, the proof is in the pudding. I'm just doing this to be transparent with you. Where do you get screwed over here? Okay. Where did I screw you over? Nowhere. The only thing is that you have to take your profit at some point. If you start turning around, you take your profit. And these can be really small transactions sometimes, okay? But you're taking them because you're waiting for the moment the volatility expands, and then hopefully the profit that you make in this one, covers any tiny stop loss triggers that you might have had in a couple of them, which is kind of the minority since most of them never end up triggering their stop loss, which I showed you in yesterday's episode, and I've also proven to you today. So I hope that makes sense. Guys, I do have an update for the hourly because we did put in some price action here. Let me see if the hourly has closed. Yeah, it just closed. So let's go ahead and just throw on the hour. And this is the new hourly. So I can turn off that learning stuff. And you can see, again, like everything else, okay, the markets aren't closed yet, but we're underneath the momentum pool here at 25,121, and we're also, not gonna be above the volatility pivot until we get above 25,662. Now this volatility pivot could come down, but overall you can see that we're still kind of bearish. Now, should we do something like this, we fall in here, and should we be able to recover the pool and we push to the other side, and then we end up holding above the bearish control zone that I have outlined here, then we will have essentially captured this liquidity, and there's a good chance that we could have a flipping this volatility pivot and the top of the momentum pool, and then that could suggest that this was kind of a fake out to the downside. But if we just kind of push up and just get to the bearish control zone here around 25.4, then I would suggest we're still bearishly oriented, both under the pool and, if bears block us. So, this is what we're going to be looking out for. Now, typically when we do have a drop like this, we often see us recover some liquidity, but we also usually have more than one drive down. So I don't know if this is over yet, guys. I'll analyze in another episode. But for this one, I just wanted to give you a brief update to remind you of the patterns that we had, as well as to give you an example of how to trade the momentum pools. Again, you don't have to trade the 1 hour. You can trade the weekly. You can trade the daily. It's all the same thing, guys. It's all the same rules. It's just that the 1 hour I can show you because, there's been a bunch of 1 hours since yesterday, and so I can actually deliver you results to analyze, okay? Whereas if I showed you the weekly, we'd have to wait like, 10 or 20 weeks to get a history on it, right? That'd be an awful long time to wait to analyze. So that's why we're looking at those tiny moves. But in reality, the reason why I give you the daily charts, the weekly charts, the 3-day charts, the reason I give you that stuff is so that you can also do it on the bigger time frames and get those bigger swings, okay? I think we can go ahead and just take a look at the 6-hour and throw on our EMAs just to see what's going on here. And you can see that we have, breached this kind of, you can see we got a nice hard rejection off of the 200 SMA, the 200 EMA, the 300 EMA, the 300 SMA. We just got a nice hard rejection off of that. And we're starting to lose for the first time the 800 on the 6-hour. So, do we flip back above there? Do we hold above 25,300? Or do we lose that area and we get down to this kind of 23-ish kind of zone, 21 to 23-ish kind of zone? I don't know. We're just holding in on that support level that I was pointing out earlier in the episode. And, let's go over to the daily. Zoom out a bit. Get some structure here to look at. And then let's go ahead and go over to our volatility. And you can see that, a while back, a couple episodes, I was showing you that we had only pushed halfway through there. Now we're closer to 55%. Okay, we were 50% here. Now we're 55%. And again, we could go all the way across the channel here, or we could get up to this like 70 to 80 zone before we bounce. So I think that we could potentially see another drive down. Let's go to the 2-day. You can see the 2-day is just expanding, so that's actually quite deadly. The 2-day suggests, if we're pushing down while the 2-day is expanding through this, and the 2-day hasn't closed yet, but if we're pushing through that, then just easily we could continue to push down, guys. 3-day, it hasn't gone yet. So again, the 2-day could be faking us out. It hasn't closed yet. 5-day is starting to expand, but it's not even above 10% yet. So again, the 2-day could be a fake out. The daily and the 2-day could be just faking us out, and maybe they just do their thing, and then maybe the 3-day and the 5-day end up taking us in a totally different direction. We don't know yet. So you have to let the 2-day play out, guys. And then the weekly. Look, the weekly hasn't even fully contracted yet, but it's almost there. You can see that its EMA is about to cross. At some point, it's going to cross, and then it's going to choose a new direction. So let's go back to the chart here. If we were to say that the weekly, was beginning to contract somewhere around here, and then it really got into high gear right up here, and then the main thrust of it was to the downside, then we could suggest that if we have a volatility flip, it could bring us to the upside. That's not guaranteed, and on our Stokes we are higher than 50%. So this thing could have a long ways to go down, actually. You can see over here, it could have a long ways to go down. Let me look at this. I mean, we could be somewhere like here, right? Where we just pushed up, and then we grabbed it, and then we continued to push up. So, yeah, the 50 area, you can see we got a little bounce here. I'll put a horizontal line here so we can see it. Oops. Let's see, let's make that white. There we go. So you can see that we got a nice bounce here. You can see we got a nice rejection here. You can see something going on here. You see a nice chop above this area over here, and that's just kind of the end of the chart to 2015. So there's not a lot of action actually going on here. But what it does say is that, there's kind of there's this zone here in the middle of the chart, which you can see some action right here, right? You can see some action right here. You can see some action right here, where we could reasonably expect the possibility of a bounce in the area that we're coming up to, okay? So I'm going to just assume that we have another drive down into this zone, and then we're going to look to see, does the stochastic RSI end up crossing back up, or does it end up losing support? And that's going to be, historically speaking, right? I mean, there's only like 1, 2, 3, 4, 5, 6, 7, 8, maybe 9 over here. On the Coinbase chart, there's only like 9 instances, okay? So this would be like the 10th one that we have to work with. But out of all of those cases, right, after all of those cases, when it turned around on these lines, the chart continued to move in that direction that it changed to. It wasn't like a fake out. It continued to move in its directional change. And so if we get a crossover either here or here, you know, either of those could take us back up north and just continue to drive the price even higher than previously. Okay. But if we break down from this top one, it's going to be our first warning, get a new clean pair of shorts, right? Because we might end up in the hospital. And then if we break down from the second one, it could be, lights out, guys, right? Like we could retest our macro lows or potentially even make new macro lows. Okay, that's the way this can work. And let me just take a little bit of an analysis here. We can see that when we turned around here, we did have a full low on this one. Let's see, when we turned around here, we also had a full low. And then we just don't have data over here. Let's see, how about this mid area? This was a high on this lower one. Yeah, so if the volatility on the Stokes RSI hits a max low here, then it is possible that we could have a volatility expansion to the upside on the Stokes RSI. And so I am going to be looking out for that. Guys, this is the weekly chart, so it could take some time. But that's a very interesting observation that I just made. And I am going to keep that in my back pocket. So if I don't mention it, you can feel free to remind me if you get interested. That is something that we should check out. Let's see, what should I call this? Stoke key. Okay. I'll take a look at that on the, where'd it go? Oh, there it is. Okay. So I'll take a look at that on the, on a longer chart, like maybe the TradingView index of Bitcoin, to see if I can have any additional data. But for now, I would want to see the volatility come down below 10% as we're approaching 50% on the Stoke RSI. And for me, that would suggest that we could have the possibility for a sudden U-turn and just a pump in the charts. But that's hopium, guys. That's copium. So I just don't want to get your hopes up too fast. Let's go ahead and just be realistic about what's going on. We are pushing on the weekly 200 EMA here, and breaking down from that isn't going to be nice. We do have the 50 SMA down here around 22.5, and we also have the rest of that fair value gap and some support around 23, let's just say 5-ish, right? And then as kind of like a backup, we have the 300 EMA over here at 21 and the 300 SMA at 20 to catch us, okay? Or to slow our roll to the downside should we breach these candle closes over here. Guys, I think I'm going to wrap it up right there. That was your alpha for the day. Stay safe, guys, all right? And happy trading.